Alright, welcome back. So this is the part of course we actually delve deep into the good stuff, the stuff that helps you compose your own strategy. So here we have a trader who just uses indicators. Just straight up indicators, only a piece of legitimate analysis they have done is a Fibonacci. Alright, Fibonacci might help you, but when your charts look like this and it's just like someone vomited all over a page and it's just too much indicators going on, especially as a beginner, it really did help. It might work for this guy, but if you're a beginner, it definitely won't work for you. This looks like someone vomited all over a page. All these pro traders tend to keep their charts clean. When their charts clean, it's easier to look at price action, which is what actually matters. So if you look at my charts here, I know there's a lot of coloring, there's a lot of unnecessary coloring, but I need this coloring because it helps me create my levels, and you know when something's a lot more visible, it's a lot easier to see. What am I talking about? It's a lot easier to predict and remember. So because it's color coded, I can remember these key levels a lot easier. Whereas if it wasn't, then I would have forgot. But basically, I've drawn all the support and resistance levels here. Yeah, in the past, in the present, in the future. Banks trading key levels. These levels support resistance. Sometimes they're Fibonacci levels, but hey, support resistance is the main thing. So here, if you look at my charts, it's very clean. Compare it to this guy's, it's just full of indicators. Only indicator I properly use is MACD, but we won't get into that. MACD is just like a little indicator. I don't really look at the MACD and go, oh yeah, I'm gonna trade off of this. Nah, it's just to help me find confluence. Yeah, and if you have too many indicators, by the way, the confluences are gonna contradict each other. You won't know whether to buy or to sell. It's gonna be more risky. It's gonna play with your psychology, and you're gonna enter trades in the wrong way, the wrong time, the wrong risk management, all because of you having 20 million different indicators on your charts. Just it's not necessary. So these are my charts. This is how I've been analyzing for a long time. It's been working great for me. This is my strategy: support, resistance, trend lines, levels. Um, I do use trend lines, and it does help, especially with these levels. They do help, but the main thing I look at is price action. Price action is what tells me. It tells me a story. I can actually look at price action and go, well, yep, this was happening. Price is currently in a downtrend, experiencing a pullback. Continue the trend, experiencing a pullback until it reaches this key level of resistance or support. So I can literally look at the charts, look at price action, just because my charts are so clean, so nice. There's no need to have all these indicators, mate. Come on. I mean, all these professional traders that you see making a lot of money. Not, I don't think any of them actually use indicators legitimately. They're just to help find confluences, yeah, in the market. Okay, so support and resistance, the main topic for today. Alright, so if you see all these levels, there's key support and resistance levels that I've been using. This is just my GU setup, but just to show you guys something, like why I actually use support and the main reasons why I use support and resistance is because the banks use them levels. But that being said, I'm not going to jump into a currency pair that I actually trade. I'm going to jump into a currency pair which I've never ever traded, ever. Alright, I just picked this by random one. AUAE, Aussie dollar, Euro. I've never actually traded this, but I'm just going to use it to demonstrate how powerful support and resistance levels can be. So because I've been trading for a while, I can literally look at this chart and tell you something about it straight away. So there is a resistance at this level. By the way, support and resistance, they're zones. They're more like zones than levels actually. You know what I mean? It tends to vary. It's not going to be exact. I mean, look at these. You get 3 weeks, 4, 5, 5 weeks. They all enter the zone. It can't be just a single line because look at some of them go above, some go below. It's a zone. So price has retraced off this level, retested, if you go into like a 4 hour time frame, you can literally see this is the more like a, I don't want to call it a double top because there's a lot of wicks, but yeah, similar to a double top. Yeah. So where can I tell you how to resistance level? Okay, so there's another. Oh, fantastic resistance here. Just gonna color code it. Um, so there's resistance at this level. Huge wick rejection shows fantastic selling momentum. The bears are taking control of this market till price reach the level 504. When price reach level 504, what happens is it retraced. Price tried to continue the downtrend, created a higher low, or a lower high, and failed to create a lower low. That means price is going to take an upturn. So I can literally look at this market and tell you price is currently at a level as well, because there has been resistance at this level. So price is currently at a level of previous resistance. These are just rough, by the way. They're not as accurate as much as I do them, but this is just to demonstrate to you. So price is at a level of previous resistance. I'm looking at the price action. I'm gonna scale down just to help me a bit more. So taking an uptrend. So price is gonna do one of two things. It's either gonna retrace of this level, retest and take a downturn, or it's going to break out, yep, and make an upturn. By the way, there's always an exhaustion phase. No matter what trend you're in, there's always going to be an exhaustion phase. Alright. So let's say, for example, here. Oh no. Let's say, for example, here. Price action didn't just go straight down. It didn't do that. It went down, exhaustion, pullback, exhaustion, pullback, exhaustion, boom. That's what price action does. Price action will never go straight down or straight up. That's not how it works. Unless there's a fundamental announcement. And that is why I don't like using the monthly or the weekly or even the daily time frames. These are the time frames that I use. So here we can literally see price created, showing some wick rejections here. I don't want to call it a double top. You know what? We're not going to call it a double top. But yeah, so I'm seeing a lot of bearish momentum. Could tell me to enter trade. By the way, this is not how I would enter trades. But let's say I was going to. I'd put the stop loss just a few pips above the wick and put the take profit all the way down. If you're feeling adventurous, which take it all the way down to the previous level of support, but I'd take it up down to around there. Risk reward ratio 1 to 4. Boom. Price action plays out. Price action takes an upturn, you're gonna lose the trade. This is inevitable. But if price action does, as I suspect, retest and continue a pullback, then it would happen. I mean, if we do further analysis, I'm pretty sure we could spot some sort of head and shoulders pattern, but we won't get into that right now. So yeah, make sure you do practice your price action. This is a skill, by the way, so you do need to practice it. The more you practice, the better you get. And only do it on the currency pairs that you trade. I only went into a currency pairs that they trade just to demonstrate to you the power of support and resistance, the levels that banks use. So you need to make sure you master that, and it will help you a lot when you're trading. That being said, let's move on.